Okay, welcome back, traders. It's John at Rain King Insights. It's time for a general market update. It's Friday, July 26, 2024. It's been a pretty volatile week in the markets. Again, the presentation is by Rain King LLC for educational purposes. So let's cover a lot this week. We're going to look at the indices. We're going to look at the unwinding of the AI trade, breadth, rotation. Is it still healthy, or are people running for the exits? And then we're going to still look at some watch list names you might want to consider to keep your eye on, and then we'll wrap up. So let's go over the indices. This is the S&P 500 as of the close today. I think it's noteworthy that, the year-to-date gains in the NASDAQ were about very close to 20%, and we've come off pretty quickly here, pretty steep. I think we're off about 5% so far. Today's, PCE generated a little bit of excitement that the Fed might, cut rates. I think there's a possibility they're saying about July, but I don't think it's really going to happen. You can see here the action of today did not even clear yesterday's high, so I can't say it was that impressive. Just marked on the chart, still can see us coming down into the range here of support, which would be a 6% or so decline. This range could go all the way to a 10% decline. If that were the case, we'd give back half of the year-to-date gains. We'll have to see how it plays out. But certainly since late June, all we've seen in terms of volume spikes have all been red, showing distribution. Half of those coming on the way up and harsh selling on the way down. Here's the NASDAQ composite. This one, I think there's some interesting things to note just from a learning perspective. Bill always would tell us that distribution in the indexes and individual stocks will happen on the way up in price. And you need to note that. And you'll look at this chart and you'll say, look at these spikes. The index was still advancing here and we were getting pullback warnings, these shaded pink areas with my indicator. But you can see spike of distribution, another spike of distribution. So there was definitely selling going on the way up. And then we actually pushed to new highs. And we talked about this a few weeks ago, how for 4 or 5 days in a row, we made new highs in the NASDAQ, but the volume was just not there. There was no demand and things were getting weaker. And then we were hit with distribution. We had two major shots across the bow with distribution showing up. And we had a very harsh day after we had a feeble rally. We had a little 3-day rally in here with really no volume at all, very, very weak. And then we had a harsh day on Wednesday. We had a 4% decline. We haven't seen that in a long time. And it was concentrated. 3.7% of that decline was concentrated in the Mag 7 stocks, worst drop in 2 years. So some heavy selling was going on this week. And it's clear that, particularly with the earnings reports of Google and Tesla, that the narrative has changed on AI. It's gone from 2023 being infrastructure investments in AI, but now the market seems to be focusing on show me the money. In 2024, they're looking for where is the revenue from all these infrastructure improvements, and where are the new AI products and services that are going to drive revenue and earnings per share. And so far, some of the word from Google was it's not happening yet, and that was a bad reaction from the market. Today's action again, the volume was lighter, below average. We just kind of spun in place. Can't say this was impressive at all as a rally attempt. So let's talk about the unwinding of the AI trade. Very, very crowded trade. Everybody was piling into NVIDIA as well as semiconductor stocks and the Mag 7. So I've pulled up the SMH. This is the semiconductor ETF. And I just wanted to play this out as it was happening, because I think there's a lot to be learned from just following the progression of what was happening and what we were seeing on the chart. So we had this correction in April, pretty sharp, and it coincided with NVIDIA correcting. And then we had this rally attempt. And you'll notice that the rally attempt at first didn't look too good because you had heavy selling and the rally was on below average volume. So it didn't look great to begin this rally. So as the rally progressed and we came up to the old highs, again, if I showed you this chart and I showed you this rally and you looked at the volume profile, it certainly didn't look impressive. There was very little volume on the way up, yet we were drifting higher. So things kind of paused a little bit as we got to the old highs. Then we broke out to new highs. We finally got some volume to come in, which looked much better. We had some volume, and then we came down our first real pullback, which held. This was encouraging. We got support off the 20-day, and it actually coincided with the base breakout, and the volume picked up to support the market and the semiconductors, which this looked much more constructive. Then we had this rally here where the market really started to go up at an accelerated pace. And we also had multiple gaps that were occurring. But you can see the volume profile again, very average volume, not really showing huge demand. So it was definitely a caution sign that maybe this was getting tired. And then we got hit with a really sharp high volume distribution day, took out a couple days lows. And then we came down because we had 3 straight lower lows, which was a bad sign on volume. And then we kind of went sideways, tried to tighten up again, and we were all paying attention to this very next rally. And this very next rally, you can see here, was even though we rallied in price, the volume was very weak. We were actually attempting to make new highs here, and the volume was very low. And then what happened right off that attempt there was that first shot, second shot really across the bow, because we had this one a couple of weeks earlier, really hard day down, volume clearly showing distribution in place. And then there was a pause, then a gap down, much more distribution. And at this point, it's clear that the market and the semiconductors had really topped, at least for a period of time. And again, it's been nothing but a pretty much a one-way ticket down for the semiconductors. Everybody seems to be running for the exits. So it's good to review the charts like this to see what were you seeing at the time and were there clues about when it was good to be long and when it was good to possibly reduce your exposure. So breadth. Last week we talked about the Whaley thrust, or I called it Whaley thrust or bust. I mentioned this anomaly we were seeing, and you can check out last week's video, but it basically was saying when the S&P was making new highs, but yet stocks percentage below the 50-day, above the 50-day was really below the 50 level, a real rare anomaly. And historically, this has only happened a few times. And when it does happen, it typically means the rally might go a little further, but then it's probably going to exhaust itself. And that's what we found out this week. So last week we looked at this super duper rally. We had gap ups. This is the S&P equal weight, some great days in here. And we looked at it and said, is this a breadth thrust on the Whaley breadth thrust? And I had pointed out that given the context that this was really the breadth thrust usually occurs at the beginning of a new rally and a follow through day, that this was probably one more of exhaustion and really telling us that the market was extended and running out of gas versus an initial thrust with power. And that's what really I think we saw this week was, it really seemed to be exhaustion. Here's the equity put call ratio. I showed it last week. Last week I pointed out that we were at very low readings, which also signaled that maybe people were becoming, too bullish. And you can see here with the sharp correction we had this week, and it was a pretty sharp bad days. We only had a little bit of increase in the put call ratio, not showing as much fear as you would expect on a sharp decline. So I would imagine that we have this pullback or correction probably has more room to the downside. I think this put call ratio has got to get much more in this upper half to show us that maybe it's run its course. So I would not be surprised to see this continue to pull in. Rotation or running for the exits. So we've been watching these. We've pointed it out in the last few videos. This is the NASDAQ equal weight. And we pointed out in early July that we were making a breakout attempt, and we did get that breakout, but this turned out to be part of this breadth thrust exhaustion. And with the tech sell-off, it's completely broken down and we have a breakout failure. So think of it this way. Tech is failing. It's no longer in the leadership sector. Here's the S&P 500 equal weight. It also broke out, showing some breadth improvement, but then it's come back. Now it's trying to recover the pivot. So it's kind of a neutral reading on this one. And then the New York Composite, probably the strongest one of the three. We had a strong breakout. We came back roughly to the pivot area. It held, and we're trying to move higher. So the composite, don't forget, has a lot more cyclicals in it and industrial stocks, and the Dow seems to be holding up a little better. So It's pretty a mixed picture. I mean, when we talk about rotation, certainly money is coming out of tech for the time being and moving to some other areas. We talked about those other sectors last week. So here's the Russell. Everybody's focusing on the sharp move up in the Russell. This week we had some pullbacks. We've consolidated. It still looks constructive. And it's consolidating. So I still think this looks good. The relative strength line is showing that this index is really outperforming. So the Russell and the small caps seem to be still an optimistic view that they might become more of a leadership role. Now, I wanted to talk a little bit further about the small cap as kind of a catch-up trade. So this chart came from Cabot Wealth Letter. This is actually small caps versus large cap sector performance, and they got this from Bank of America's flows report. And what it shows is at the big level, the flows into small caps in the last 4 years has been about $37 billion. But in comparison, large caps received about $789 billion. So clearly, small caps have been underappreciated. Now, small caps, the forward PE on small caps right now is about 14.9, and it's really at the low end of the normal PE of the last 25 years. And you can see in this chart, when we look at something like technology, here's the performance in small caps technology, 3% versus big cap technology, 17%. So could there be a catch-up trade as we get into the fall and the end of the year with some rate cuts? Definitely the potential for that. And we like technology, growth stocks. You can also see some other areas, energy. You can see the indexes themselves. So pick the sector you're interested in, but there certainly could be some catch up. Now, small caps, you know, they may be starting to discount interest rate cuts. And that could happen for a while. We might start to finally see the cuts come through, and the small cap trade might have plenty of room to run. You know, with lower finance costs for smaller companies that can help them boost their earnings per share, as well as the price to earnings ratio of those companies can expand. And we know that growth companies expand their PE ratios in the right market environment. So if you're looking at small caps and you want to look at some ETFs, the IJR, the VBK, as well as IWO, which is small cap growth stocks, maybe some ways to play this on the ETF side, as certainly you can look at individual stocks. So I want to go over some watch list names. There's just a couple of names that have caught my eye that relate to small caps, or they relate to some of the sectors that could perk up if we get some rate cuts. So here's an oldie that hasn't performed well in the last couple of years. This is Lending Tree, symbol TREE. And what I wanted to point out is, you know, this is a monthly chart. This stock, when it really gets going in the right market environment, can perform. And I just wanted to check that because here it went from 8 in 2012, and on a 7-year run, it went to 443. So this stock can perform. It's over 5,000% increase over 6, 7 years. So we have a stock that can perform, and institutions will buy this stock under the right conditions. Now, if we look at the weekly, what's interesting on the weekly chart is, the stock bottomed in late 2023 as the November rally started. And you can see simply we got a nice prior uptrend here in Lending Tree. And the stock has actually formed a nice little cup base. And you'll notice that the spreads in this base have gotten much tighter. This shows that there's some institutions that are accumulating the stock, and it's hard to miss on the weekly chart. Look at all these blue spikes. 1, 2, 3, 4, 5, 6, 7 spikes. That's showing you again, this prior uptrend was built by institutions that are building positions. Look at the range expansion. And then we have this nice consolidation, and the consolidation came on a volume dry up. This looks very, very interesting as really a turnaround play in terms of earnings, but it had a good week, and it may have room to run in the right environment. So I keep this one on my watch list. Here's another one, Rocket Companies. This is a company that does mortgages. Again, they could benefit from a couple of different things. The interest rates coming down might spur more home buying. And that could be really good, particularly for the millennials that have been kind of locked out of buying their first house because of the high interest rates for the last couple of years. So Rocket has been in a long consolidation since the beginning of this year. So this is a 7-month base. And you can see it went from being kind of deep and loose, and it got tighter and tighter and tighter. It's consistently was failing around the 15 price level, 1, 2, 3 times. Now it's really tightened up a little bit in here, and we've got the volume. We had a quiet little pause, and the stock actually reached a closing high today. So it actually is a breakout. Volume picked up, and you can see the relative strength line is at new highs. So this one looks very interesting on the charts. So you might want to keep your eye on that one. And the home builders, again, I think they can benefit from the rates coming down. Here are three major players in the sector: DH Horton, not Dr. Horton, but DH Horton. This one had broken out and is starting to consolidate a little bit. Toll Brothers today, I took this chart yesterday. Toll Brothers actually galloped higher today, and the relative strength line was in new highs before price, which is a really positive sign. And here's KBH Homes. I mentioned this last week. It also was one of the first ones to break to new highs, and the RS line is at new highs. I do mention that I have a position in KB Homes. This one I think I like a lot because it was the first to break out. Plus, KB Homes focused on new home buyers, and that would be the millennials that might benefit from lower interest rates to buy their first home. Also, keep your eye on new merchandise. I showed this last week. I showed a number of IPOs that you should keep your eye on. You want to add to these lists, but don't take your eyes off of young, new merchandise in the tech sector and the IPO markets. So let's wrap up. It was a volatile week. We had a very sharp pullback. It was pretty straight down this week. Not a lot of powerful rallies. You know, an 8 to 12% correction could be in the cards. August tends to be a very slow month in the markets, not a great month. And September and October are also seasonally not great months. And but maybe that's counteracted by some rate cuts that come in either July or September. Who knows? We have an election coming up, which is literally changing every day. So could be volatile. I still think we're kind of in a chop through the summer. If I were to try and look ahead, I think it's going to be choppy through the election. But I do think the fundamentals of the market with interest rates coming down, no matter who gets elected as president, I think the bull market will continue into 2025. Now, the indexes are below their 20 EMAs. That's really telling us we are now no longer really in an uptrend, power trend type of environment. New highs and new lows have kind of cooled off this week because we've seen a lot of selling. Not horrible, but they've cooled off. The action of the leading stocks, you know, we saw some stiff selling in the Mag 7 and the semiconductors, and Google and Tesla's earnings reports did nothing to really support the market. You know, we're still in a bullish uptrend. We want to keep our eye on those relative strength stocks, but we want to open ourselves to other sectors like housing, potentially finance, payment systems, et cetera, that might be part of this interest sensitive sector catch up, particularly with the small cap names. Exposure levels, I'm lowering them a little bit. There was a lot of selling. I tried some pilot positions, got knocked out, took my small losses, I think 20 to 30%. I think stock selection is becoming really, really important. I think tech is probably going to go sideways for a while. You'll notice that my exposures probably have been lower than most people. I'm certainly been much lower than IBD since early June, which has been somewhere in the 80% plus range. I've been saying for a while we could have sideways chop, that maybe the market was getting a little overheated. And I think this really comes back to you got to trust your tools. You know, I've been looking at sector leadership. My tools are sector leadership, breadth, new highs, new lows, the leading stocks, and of course, price and volume. And they've been telling me since early June that the market environment was not really healthy. It was thin, and we might have been seeing some exhaustion in early July. So I was trusting my tools. That leads me to my lower levels of exposure, which turned out I think are been okay. They've been more on the conservative side, but you have to be flexible. You know, these indicators are not perfect, but you want to be flexible. I took some pilot positions when the market looked like it might have a little bit of a rally left, and you get stopped out. You have to back away. So the healthy rotation we thought we had a couple of weeks ago seems to be morphing into definitely a pause. The equal weight S&P and the equal weight NASDAQ 100 have had failed breakouts. So, it's certainly there's a run for the exit from some of these semiconductors and some of the AI names, but things need to probably consolidate. There's a lot of money moving around, getting repositioned for a new president, and it's also getting repositioned for interest rate cuts. So it could be a volatile environment for the next couple of months. We've seen the VIX this week, I think, go from the 12 range up into the like 17% range today. So volatility could be back for a while. All right. So the quote of the week is from Richard D. Wyckoff. Trading in stocks without scientifically limiting your risk is like wearing your pants without either a belt or suspenders. Words of wisdom from Richard Wyckoff. If you haven't checked out my new website, check out Ranking Insights. A lot of material on the site. Sign up for a membership, a free membership. You can get access to some of my GMU extras, which are great short 10-minute videos on a trading topic, and some of the presentations I've given in other forums. So check it out. It's worth a look. Okay, everybody, that's the general market update for July 26th. As a reminder, next week, August 1st, will be the final general market update that is free to the public. At that point, we'll be moving to a free version that becomes out the first of the month. The other three in the month are essentially behind the paywall. So I hope you'll join me in getting a basic membership so you can stay up to date. We've had people on the right side of the market through market bottoms in 2022 and the market top in 2021. And that's proven through my 3 years of doing these general market updates, which are all on file on my YouTube channel. So we'll see you soon. Have a great weekend, everybody.